10 specific moves are sitting inside the United States tax code right now, written into federal law by Congress for the explicit purpose of being used, and the average American retiree will use exactly 0 of them this year, next year, and every year after that until the windows close and they cannot be claimed at all. Somewhere between $40,000 and $400,000 of completely legal, completely public, completely available tax savings are walking out the door of the typical American retirement household every single year, because the people who profit when those strategies go unused, your bank, your brokerage, the IRS itself, have a direct financial interest in not explaining them to you. In the next 25 minutes, I'm going to walk you through 10 of them, one at a time. Quick disclaimer, nothing in this video is financial or tax advice. Talk to a credentialed tax professional before you act on any of it. Strategy number 1, the buy and borrow strategy. This is the single most powerful tax move in the entire United States tax code, and your bank will never explain it to you. It combines 3 rules. 1, you owe no capital gains tax on an appreciated asset until you sell. 2, when you take out a loan against an asset you own, the cash you receive is not taxable income. 3, when you pass an asset to your children at the end of your lifetime, the cost basis resets to the fair market value on the date of your passing. That is the step up in basis. Every dollar of growth during your lifetime is wiped clean for tax purposes. Put those 3 rules together. Imagine a retired teacher in Ohio who bought $100,000 of an S&P 500 index fund in 1995. By 2026, the position is worth $700,000. $600,000 of embedded capital gain. If she sells, she owes federal long-term capital gains tax of up to 20% on a portion of that gain, plus the 3.8% net investment income tax, plus whatever state tax her state imposes. $120,000 to $150,000 of tax on a single sale. But she does not have to sell. She calls her brokerage, sets up a securities-backed line of credit against the position, and borrows against it at 5 to 7% interest. That borrowed money is not taxable income. She uses it for whatever she would have used the sale proceeds for. Then at the end of her lifetime, the position passes to her son with a stepped-up basis of $700,000. He can sell the position the next morning and owes 0 federal capital gains tax on the $600,000 of growth that happened during her lifetime. The name of this strategy has a harsher third word that I will not say, so I will call it the buy and borrow strategy. There is real risk here. Securities-backed lines of credit carry variable interest rates. If the market drops sharply, the brokerage can issue a margin call, demanding you either deposit cash or sell to bring the loan-to-value ratio back into compliance. The guideline is never to borrow more than 30% of the portfolio's value, and to keep enough cash on hand to cover at least 2 years of interest without touching the line. This strategy helps the retiree with appreciated assets in a taxable brokerage account, not the retiree whose entire net worth is inside an IRA or 401k. For the retiree with $200,000 or $300,000 in a taxable investment account that has been growing for 20 years, this is the single largest tax move available. Strategy number 2, net unrealized appreciation, called NUA. This one helps the retiree who spent a long career at a company that paid them in employer stock inside their 401k. Someone who worked at Exxon, General Electric, Coca-Cola, IBM, anywhere stock was part of the retirement plan. When you take a lump sum distribution from your 401k at retirement, the default is to roll the whole thing into an IRA. That is what your brokerage will tell you to do. But if a significant portion of your 401k is an employer stock that has grown substantially in value, that default is one of the most expensive mistakes available in the tax code, and it is irreversible once made. Here is what to do instead. The IRS allows you to take the employer stock portion of your 401k and move it in kind, meaning the actual shares, into a regular taxable brokerage account, while rolling the rest of the 401k into an IRA. You pay ordinary income tax in the year of the distribution, but only on the original cost basis of those shares, what the company paid for them when they put them in your plan, not what they are worth today. The growth on those shares, the net unrealized appreciation, hence the name, does not get taxed at ordinary rates. It gets taxed at long-term capital gains rates, and only when you sell. Imagine a retired manager who worked at the same company for 28 years. His 401k has $600,000 total, $300,000 of that in employer stock. The original cost basis on that stock was $50,000. If he rolls everything into an IRA, Every dollar he eventually pulls out is taxed at his ordinary income rate. If he uses the NUA election, he pays ordinary tax in year one on just the $50,000 basis, roughly $11,000 of federal tax, and the $250,000 of growth sits in his taxable brokerage waiting to be sold at long-term capital gains rates, which for most retirees is 0 or 15% depending on income. The difference between the two paths is $40,000 to $60,000 of tax saved. The election is only available at the precise moment of the lump sum distribution. Once you roll the stock into an IRA, the door slams shut forever. Strategy number 3. The 0% long-term capital gains bracket. This is the single most underused gift in the 2026 tax code, and it disappears the year you start taking required minimum distributions, so the window matters. The federal long-term capital gains rate has 3 brackets: 0%, 15%, and 20%. And the 0% bracket is wider than almost anybody realizes. For tax year 2026, if you are married filing jointly and your total taxable income comes in below $98,900, every dollar of your long-term capital gains is taxed at 0%. For single filers, that line is $49,450. And remember, taxable income is your income after deductions, not your gross income. The 2026 standard deduction for a married couple filing jointly is $32,200, plus $1,650 per spouse if both are 65 or older, plus the new senior bonus deduction of $6,000 per spouse for those over 65, on the books through 2028 unless Congress extends it. Stack all that together. A married couple, both over 65, can have gross income of roughly $146,000 in 2026 and still land below the 0% capital gains threshold after deductions. They can sell appreciated investments, harvest the gain on purpose, and pay 0 federal tax on it. They can do it again next year and the year after. Every year between when they stop working and when RMDs start at 73, their income is at the lowest point it will be in 3 decades. The correct move in that window is to deliberately realize as much long-term capital gain as fits underneath the 0% ceiling every single year until the window closes. The retirees who do not do this end up either selling later in a much higher bracket or paying ordinary income tax on the gains through their IRA. Same money. Vastly different result. Strategy number 4. The Roth conversion ladder. This is the companion to Strategy 3, and it solves a problem most retirees do not know they have. If you have a traditional IRA or 401k, every dollar that comes out is taxed at ordinary income rates. Starting at age 73, the IRS forces you to take required minimum distributions whether you need the money or not. Those forced distributions can push you into a higher tax bracket, increase the portion of your Social Security that gets taxed, push you across the IRMA A threshold, and raise your Medicare premiums, and leave your surviving spouse filing single, at which point the brackets compress in half and the effective tax rate on the same income jumps significantly. The Roth conversion ladder diffuses all of that before it happens. In the low-income years between when you stop working and when RMDs start, you take voluntary distributions from your traditional IRA, pay ordinary income tax at your current low bracket, and move the after-tax amount into a Roth IRA. From the moment that money lands in the Roth, every dollar of future growth is tax-free, and the Roth has no required minimum distributions during your lifetime. A 66-year-old couple with $800,000 in a traditional IRA, living on Social Security and a small pension with taxable income around $40,000, sits in the 12% bracket. They convert $50,000 a year for 7 years at 12%. By the time RMDs start, the IRA balance is much smaller, the forced distributions are much smaller, Social Security taxation drops, Medicare premiums stay below RMAA, and the surviving spouse inherits a Roth that throws off 0 taxable income. The total lifetime tax avoided often runs well into 6 figures. The rule that matters is bracket management. Convert only as much as fits cleanly inside your current low bracket, never enough to push you into the next one. Strategy number 5, the Qualified Charitable Distribution, the QCD. This one helps the retiree who is at least 70 and a half and gives to charity even a little. Once you cross that age line, the IRS allows you to direct money straight from your traditional IRA to a qualified charity, up to $111,000 per person in tax year 2026, and the amount you direct does not show up on your tax return as income. It is not a deduction, it is an exclusion. The dollars never enter your adjusted gross income in the first place. And because so many other things in retirement are tied to that number, Social Security taxation, ARMA AA premiums, the new senior bonus deduction phase-out, the medical expense deduction floor, keeping it lower has a cascading effect that often saves more on the side calculations than the charitable contribution saves on the main return. A widowed retiree, age 73, has an annual RMD of $18,000. She gives $12,000 a year to her church. Under the old way, she takes the $18,000 RMD into her income, then tries to deduct the $12,000 church donation as an itemized contribution. But starting in 2026, only charitable contributions above 0.5% of adjusted gross income are deductible at all, on top of having to itemize, which most retirees do not, because the standard deduction is much larger than their total itemized amount. Under the QCD path, she instructs her IRA custodian to send $12,000 directly to the church. That $12,000 counts toward her required minimum distribution. The remaining $6,000 comes to her as ordinary distribution. Her adjusted gross income drops by $12,000 compared to the old method. Social Security taxable portion drops. Medicare premium drops if she was near RMAA. The senior bonus deduction phases out slower. The church receives the same amount. For a retiree in the 22% bracket, the difference between the two paths is typically $2,500 to $3,500 of tax saved every single year for the rest of her life. Almost no retiree who gives to charity should be doing it any other way after 70 and a half. Strategy number 6, the home sale exclusion. This is Section 121 of the tax code, and it is the single largest one-time tax benefit available to almost any homeowner in America. The rule is straightforward. If you have owned your home and used it as your primary residence for at least 2 of the last 5 years before the sale, you can exclude up to $250,000 of capital gain from the sale if you are single, or $500,000 if you are married filing jointly. Gain means sale price minus what you originally paid, minus improvements. A couple who bought their home in 1985 for $90,000, put $50,000 of improvements into it over 40 years, and sells in 2026 for $640,000 has a gain of $500,000. Their federal capital gains tax on that gain is zero. The entire $500,000 of appreciation walks across the closing table tax-free. But the rule has teeth. The 2 of 5 year test is rolling. It looks at the most recent 60 months before the sale. The day you move out, the clock starts ticking. You have 36 more months to sell before you fall below the 24-month threshold. A retiree who moves to a senior living facility in early 2024, lists the house in late 2026, and closes in 2027 has cut the timing too close. The IRS does not care that they lived in that home for 40 years. The test looks only at the last 60 months. If the house was empty or rented for more than 36 of those months, the exclusion is partially or completely lost. The single most expensive mistake a retiree can make in the year they sell their longtime home is letting that clock run out. If you are going to sell before the clock runs out. There is also a partial exclusion for moves due to health reasons or unforeseen circumstances, but it requires documentation, typically a letter from a physician, and it has to be applied for on the return. It does not happen automatically. Strategy number 7, the Charitable Remainder Trust, the CRT. This one helps the retiree with a large appreciated asset, a piece of real estate, a chunk of company stock, a small business that they want to convert into lifetime income without paying a massive capital gains tax bill the day they sell. You set up an irrevocable trust, you donate the appreciated asset to it, the trust sells the asset and pays no capital gains tax because it is a charitable entity. The trust then pays you, or you and your spouse, a stream of income for life, or for a fixed term up to 20 years. Whatever is left at the end passes to the charity you named when you funded the trust. You get a partial charitable deduction in year 1, a guaranteed income stream you cannot outlive if structured as a lifetime annuity, and the appreciated asset that would have generated a 6-figure tax bill on sale is converted into a tax-advantaged income source. A retired couple owns a rental property in Florida they bought 30 years ago for $120,000. Today, the property is worth $700,000. They are tired of being landlords, but if they sell outright, Federal capital gains tax, even at the 15% rate, runs about $87,000 plus state tax plus depreciation recapture that can run another $40,000 or $50,000. They donate the property to a CRT. The trust sells it tax-free. The full $700,000 is invested. The couple receives roughly $35,000 to $40,000 a year for the rest of their lives. They get a partial charitable deduction up front of roughly $150,000. When both spouses have passed, the remainder goes to the charity they named. A CRT is not free to set up. Legal and administrative costs run $3,000 to $7,000 to establish and a couple thousand a year to maintain. But for the retiree sitting on a single highly appreciated asset who wants lifetime income, this is the cleanest path through the tax code, and the only professionals who recommend it are estate attorneys who specialize in it. Strategy number 8, the donor-advised fund, the DAF. The simpler cousin of the CRT, it solves a specific problem the average charitable retiree runs into every year. The 2026 standard deduction for a married couple filing jointly is $32,200 plus the senior add-ons. To benefit from itemized charitable contributions, your total itemized deductions have to exceed the standard deduction for a retired couple whose mortgage is paid off, who lives in a state with low property taxes, and who gives a few thousand a year to charity. The itemized total never gets there. They take the standard deduction every year, and the charitable contributions provide zero federal tax benefit. The donor-advised fund fixes that with a technique called bunching. Instead of giving $4,000 a year to charity for 5 years, you put all $20,000 into a donor-advised fund in year 1. The fund is an account at a brokerage like Fidelity Charitable, Schwab Charitable, or Vanguard Charitable. The contribution counts as a charitable contribution in the year you make it. You take the full $20,000 deduction in year 1, which pushes you over the standard deduction threshold, and you itemize that year. Then over the next 5 years, you direct the fund to send $4,000 at a time to the charities of your choice, on the same schedule you would have given anyway. The charity receives the same money. One full deduction every 5 years instead of 0 useful deductions in any year. The donor-advised fund also lets you donate appreciated stock instead of cash. You get a deduction for the fair market value. The fund sells the stock at no tax, and you never recognize the embedded capital gain. 2 separate tax benefits on the same transaction. Strategy number 9, the Health Savings Account, the HSA. This is the account the IRS treats more generously than any other retirement vehicle in the entire United States tax code, and almost nobody over 60 understands what it actually is. 3 tax advantages. 1. Contributions are deductible from your taxable income in the year you make them. 2. Money inside grows tax-free. Dividends, interest, and capital gains all included. 3. Withdrawals for qualified medical expenses are also tax-free. Triple tax advantaged. There is no other account anywhere in the federal code that gives you all 3. The catch most retirees believe is that you cannot contribute to an HSA after 65 once you enroll in Medicare. That is true. The moment you enroll in any part of Medicare, you can no longer make new HSA contributions. But here's the trick almost nobody knows. You do not have to enroll in Medicare at 65 if you are still working and covered by a qualifying high-deductible health plan through your employer. You can delay Medicare Part A enrollment, continue contributing to the HSA, and keep stacking triple tax-advantaged contributions through your late 60s or beyond. For 2026, the contribution limit is $4,400 for self-only coverage and $8,750 for family coverage, plus a $1,000 catch-up for anyone 55 or older. One important detail: you cannot have already collected any Social Security retirement benefit, because Social Security enrollment automatically triggers Medicare Part A 6 months retroactively. This strategy is for the working retiree who is delaying both Social Security and Medicare while on an employer high-deductible plan. The second move almost nobody uses. After 65, the HSA stops being just a medical account. Withdrawals for non-medical reasons are still subject to ordinary income tax, but the 20% penalty that applies before 65 is gone, which means the HSA now functions exactly like a traditional IRA for any non-medical spending. A retiree who has been quietly stacking HSA contributions for 15 years and let the balance grow to $160,000 now has a triple tax-advantaged account that can either fund any qualified medical expense tax-free for life or backstop ordinary retirement spending with the same tax treatment as a traditional IRA. The retirees who max out the HSA every working year in their 50s and 60s end up with the single most flexible tax-advantaged dollars in their entire portfolio. Strategy number 10. The Mega Backdoor Roth. This is the most advanced move on this list, and it applies to the smallest group of people. But for that group, it is the single largest annual tax-advantaged contribution opportunity anywhere in the United States retirement system. What it requires: you have to be still working. Your employer's 401k plan has to allow after-tax contributions beyond the regular pre-tax or Roth deferral limit. And the plan has to allow either in-service distributions or in plan Roth conversions of those after-tax dollars. Not every plan offers these features. The plans that do tend to be the larger employer plans at major corporations, tech firms, and some professional services firms. The mechanic. For 2026, the regular employee 401k deferral limit is $24,500, plus $8,000 of catch-up if you are 50 or older, plus a special enhanced catch-up of $11,250 for those aged 60 through 63 under the Secured 2.0 rules. But the total annual additions limit, meaning everything that can go into the plan from all sources, employee plus employer plus after tax, is much higher. The gap between the employee deferral limit and the total annual additions limit is the space the Mega Backdoor Roth fills. You contribute after-tax dollars into that space, then either pull them out into a Roth IRA through an in-service distribution or convert them inside the plan to a Roth 401k source. Either way, the contributions sit in a Roth that grows tax-free for life and is never subject to required minimum distributions during your lifetime. For a retiree still working part-time at 63 with the right plan, this can move $30,000 or $40,000 a year into a Roth that would otherwise sit in a regular brokerage account or never get saved at all. Call your plan administrator and ask 3 questions. 1. Does the plan allow after-tax contributions beyond the regular deferral limit? 2. Does the plan allow in-service distributions of after-tax contributions or in plan Roth conversions? 3. What is the current annual additions limit for this plan year? If the answer to question 1 or question 2 is no, the strategy does not apply to your plan and there is no workaround. If the answer to both is yes, you have a window almost no other retiree in America has access to. That is the complete list. 10 strategies, all written into the federal tax code, all completely legal, all completely public, all available right now in tax year 2026. The retirees who use these strategies are not smarter than the retirees who do not. They are not richer. They are not better connected. They just had one thing in common. Somebody told them the strategy existed. That is the entire difference. Almost every one of these has a window, an age window, a calendar window, an income window, and once that window closes, the option is permanently gone. The most expensive day in any retiree's planning life is the day after a window has closed and nobody told them it was open. If this video was useful to you, the most helpful thing you can do right now is hit the like button, because that is the single signal that tells the YouTube algorithm to put this in front of more retirees who need to see it. Subscribe if you have not already, so the next breakdown lands in your feed. And if you know a friend, a sibling, a parent, or a neighbor over the age of 60 who has a brokerage account, employer stock, a long-time home, or a habit of giving to charity, send them this video directly. YouTube is also showing you a video right now on the screen because they think it is the next thing you need to see. Go ahead and click it. I will see you in the next one.